Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kite Realty Group Trust Annual Report. Kite Realty Group is a leading real estate investment trust that specializes in owning and operating open-air shopping centers and mixed-use properties. The company's portfolio consists of necessity-based grocery-anchored neighborhood and community centers, as well as vibrant mixed-use assets located in high-growth Sunbelt and strategic gateway markets. The company provides various businesses and services through its extensive portfolio, including grocery-anchored neighborhood and community centers, mixed-use properties with a combination of retail, office, and residential spaces, open-air shopping centers that offer a convenient and accessible shopping experience for consumers with over 60 years of experience in developing, constructing, and operating real estate. Kite Realty Group has established itself as a premier owner and operator of high-quality retail and mixed-use properties. The company's expertise in optimizing its portfolio to maximize value and return to shareholders has enabled it to maintain a strong presence in the market. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase. The stock price of Kite Realty Group Trust has increased significantly in the past year due to several factors. One major reason is the company's strong financial performance. Kite Realty Group Trust has consistently reported high occupancy rates and rental income growth, indicating a stable and growing revenue stream. This stability and growth have attracted investors, causing the stock price to rise. Another factor contributing to the increase in stock price is the company's strategic expansion plans. Kite Realty Group Trust has been actively acquiring new properties and expanding its portfolio, which is expected to drive future growth and increase shareholder value. The company's focus on urban infill development and redevelopment of underutilized assets has also contributed to its success. Additionally, the overall real estate market conditions have been favorable in recent times, with low interest rates and a strong economy driving demand for commercial properties. This has created a positive environment for companies like Kite Realty Group Trust to thrive and increase their stock price. Lastly, the company's commitment to sustainability and environmental responsibility has also gained attention from investors. Kite Realty Group Trust has made significant strides in reducing its carbon footprint and implementing energy-efficient practices, which is seen as a long-term growth strategy and a key differentiator in the industry. Overall, the combination of strong financial performance, strategic expansion plans, favorable market conditions, and commitment to sustainability have all contributed to the increase in Kite Realty Group Trust's stock price over the past year. Kite Realty Group Trust maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Kite Realty Group Trust trades at a higher price-to-earnings ratio of 40 times and a higher price-to-book ratio of 1.73 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.57%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Firstly, contractual rent growth has been a significant contributor, with a 2.9% increase in same-property NOI in 2025 compared to 2024. Additionally, higher base rents driven by positive new and renewal leasing spreads have also played a crucial role, with a blended cash leasing spread of plus 13.8% on 501 comparable leases. Another important factor is the increase in average base rent, ABR, per square foot, which rose by $1.48 or 7% from the prior year to $22.63 as of December 31, 2025. The company's strategic acquisitions, such as Village Commons and Legacy West, have also contributed significantly to revenue growth, with a total investment of $476.6 million. On the other hand, dispositions have resulted in a loss of $288,865,000, which has negatively impacted revenue. Furthermore, amortization expenses related to deferred leasing costs, lease intangibles, and below-market lease liabilities have also had a negative impact on revenue growth. However, these factors can be managed through strategic planning and financial management. Overall, the company's ability to balance these drivers will play a crucial role in determining its future revenue growth or decline. Net income, a significant increase. The net income of a company experienced a substantial increase from $4,071 attributable to common shareholders in 2024 to $298,663 in 2025. This represents a staggering plus 92% growth. However, it's worth noting that this figure was affected by tax liabilities and penalties, profit margins. Improved performance despite some fluctuations due to non-deductible excise taxes on dividends paid and potential penalty taxes on prohibited transactions. The company's profit margins showed significant improvement in 2025. This can be attributed to a combination of factors, including increased net income and decreased expenses. Additionally, same property NOI grew by 2.9% in 2025 compared to 2024, while operating retail portfolio ABR per square foot increased by 7%. These improvements contributed to the overall enhancement of profit margins. The company's financial performance is a testament to its ability to generate significant operating cash flow. According to the provided summary, the net cash provided by operating activities for the year ended December 31, 2025, was a substantial $429,659,000. This figure not only indicates a positive operating cash flow, but also highlights the company's efficiency in managing its operations. The company's reliance on free cash flow to fund projects further underscores its ability to generate sufficient operating cash flow. This is a crucial aspect of any business, as it enables companies to invest in growth initiatives and maintain their financial stability. The consistent mention of positive operating cash flow throughout the document reinforces this notion, providing confidence in the company's financial health. In conclusion, the evidence suggests that the company is indeed generating positive operating cash flow, which is a key indicator of its financial strength and resilience. This ability to generate significant operating cash flow will undoubtedly play a crucial role in driving the company's future growth and success. The company's debt level and interest expenses have undergone significant changes in recent years. As of December 31, 2025, the consolidated indebtedness outstanding was $3 billion, a substantial increase from previous years. The combined cash and borrowing capacity on the revolving facility also increased to approximately $1 billion. The company issued new debt in the form of notes due 2032 and 2031, totaling $650 million. Additionally, the senior unsecured notes decreased by $130,000, while the unsecured revolving line of credit increased from $0 to $85,000. The total principal balance of outstanding debt reached $1.23 billion. Interest expenses have also seen a notable increase, rising by 5.3% in 2025 compared to 2024. This growth can be attributed to new debt issuances and increased borrowings, which have resulted in higher interest rates. The weighted average interest rate increased from 4.28% to 4.36%. Overall, the company's debt level and interest expenses have experienced significant changes, indicating a shift towards more borrowing and increased financial obligations. Management is optimistic about the company's outlook and strategy. Despite incurring LTIP expenses of approximately $2.5 million in 2026 and $1.4 million in 2027, the company remains focused on its long-term goals. The management expects to continue growing its revenue through the acquisition of new properties and diversifying its asset classes. The company's financial highlights demonstrate a strong performance, with net income reaching $123 million and funds from operations, FFO, totaling $143 million. The diversified real estate portfolio, comprising 94 properties with 7.5 million square feet of leasable space, is expected to drive future growth. Management has also taken steps to manage its debt, hedging $150 million in variable rate debt to a fixed rate through July 17, 2026. This strategic move will help mitigate potential risks and ensure the company's financial stability. Overall, management's expectations suggest a positive outlook for Kite Realty Group Trust, with a focus on long-term growth and financial sustainability. The company has made significant acquisitions and divestitures in recent years. In terms of acquisitions, the company purchased Village Commons in Miami for $68.4 million, acquiring a 100% interest in the property. Additionally, it acquired a 52% interest in Legacy West in Dallas/FT, worth for $408.2 million. On the other hand, the company has also made several divestitures. One notable example is Eastgate Crossing, a multi-tenant retail property that was reclassified from the operating portfolio due to significant disruption caused by severe flooding. Furthermore, 2 operating retail properties were classified as held for sale as of December 31, 2025. The company also sold $621.7 million worth of larger format and other non-core assets in 2025. The company's financial history reveals a commitment to returning value to its shareholders. One way it has achieved this is through dividend payments. The records show that the company has indeed paid dividends, indicating a consistent effort to distribute profits among its investors. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to repurchase its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for existing shareholders. The records confirm that the company has bought back shares on at least one occasion, demonstrating a proactive approach to managing its capital structure. There are no concerns about inventory buildup or supply chain disruption present in the extracted summaries. A thorough review of relevant pages reveals a consistent indication that these issues are not mentioned. This suggests that the current situation does not pose any significant risks related to inventory accumulation or disruptions in the supply chain. That concludes the financial summary for Kite Realty Group Trust. Feel free to comment below, and I will be happy to answer them when possible.